All right.
All right, we are recording. I have my buddy Stephen Courson on. We're going to be doing a webinar on the 5 tips to invest in scary times. Those include how to understand your why, where should you start, how to see if a stock is a strong or weak stock in 60 seconds. I'll actually show you how to do that with and without Tykr. And then when do you buy and sell? It's like the most common question we get. And then we'll talk about how to stay disciplined. So for those of you that are on the call here and don't know me, my name is Sean Tepper. I'm the founder and CEO of Tykr. Long story short, platform was originally built with an Excel sheet back around like 2015 or 16. I used it for about 4 or 5 years to make returns that ranged between like 15 and 16%. I made this Excel sheet so it would gamify the experience and really give me a definitive decision, because a lot of platforms out there, they're nice, but they're not great. And the gamification was the point system that you see in Tykr today. So brought me to 2019. I started talking to some people about this Excel sheet, which would take like 10 minutes to analyze one stock. It was very cumbersome. But everybody in 2019 that I showed it to was like, when are you going to turn this into a software so others can use it? And I was like, all right, I've got a software idea. I always wanted to create a SaaS. I always liked Netflix and MailChimp and Salesforce. So it took about a year to build the first version. After it went live in 2020, it took about 6 months to get the first paying customer. Very humbling experience, but brought on a lot of customers on that journey for free in return to get feedback. I found building tech the best way to do it, get feedback from the customers. And that's how you build something that people, it's not Field of Dreams here. It's like you can't build it and they will come. You got to listen to your customers. So, and then fast forward to today, we have a little over 8,000 customers in about 50 countries. And some of my customers here probably heard me say this before, but do not listen to what I have to say about Tykr. I always say, go see what our customers have to say on Trustpilot, where we have a 4.9 out of 5. We're really big on customer service and just providing the best experience we can. So that's a little on me. I'll turn it over to you, Stephen, and then we'll dive into the top 5 here.
Of course. What in the world? Can you hear me okay?
I got you loud and clear.
Just switched over last second from my microphone to my MacBook. I have no idea why, but hey, this is why we love and hate technology, right?
Right
So,
on.
no, thanks so much for having me on, Sean. It's been fun just interacting with you over the past couple months in different capacities, and excited that we get to do this. So, I have a really weird wealth building journey, and for what I'm doing now, it's pretty. How in the world did you get here? And basically, just what it came down to was I graduated college and I had a very strange conversation with this HR lady, and she used all these big fancy words like 401ks, Roth IRAs, ESPPs, and all these things. I had no freaking clue what any of that meant. So that really freaked me out. And, I kind of started my journey there, with books, podcasts. I was like, I got to learn about this money thing because I don't know anything. And thanks all those years of school and college.
Mm-hmm.
So, so then fast forward, I do 14 years of B2B sales, working with Fortune 500 companies at the C level in different capacities, whether it was selling technology, management consulting, different things like that. And I learned so much just interacting with people at that level, very smart people talking about business strategy, specifically technology, a lot of different things there. And all along the way, kind of a guinea pig in investing, doing stocks, got into crypto in 2017. A lot of different just side hustles and trying different things out. So I've learned a lot along the way. And then basically about 18 months ago, decided to, instead of taking a promotion into management, decided to quit my job and start full-time helping people on their wealth building journey. And I have a community to where we are focused on wealth building. There's a couple different categories of that. Won't get into the details right now.
Mm-hmm.
And then have some online courses and then mastermind trainings that we do as well along the way. So that's me in a nutshell. Started doing it about 5 years ago on the side, and then had a lot of just joy helping people, better their situations, and said, hey, let's give this thing a go. So that's me.
Awesome. And for context there to the audience, if you are interested, I had Steven on my podcast, Payback Time. If you guys haven't jumped over to that podcast, it was actually season 3, episode 38. And you can hear more backstory on Steven there, but worked with Salesforce, correct? That was one of the
Right.
large companies. Yep.
Yep.
And really big on investing. So we kind of hit it off right away, like, nice, you're investing in individual stocks. That's how you really accelerate your wealth building process. Just for those that haven't used Tykr or not familiar, you have stocks, individual stocks, which are great for building your wealth. And then if you're at a point in your life where you're nearing financial independence or retirement, or if you sold a business, sold real estate, or inherited capital from a loved one, that's when we recommend more of those ETFs, index funds, and mutual funds. That's more wealth protection as opposed to wealth building. But if you're still working and you've got a timeline to retire, you should be Warren Buffett style investing in those individual stocks. We're going to be touching on that a little bit today. So with that being said, let's jump into that first tip, which is how to understand your investing. Why? I'll let you take it from here, Stephen.
Yeah. So for this, I think it's really important. A lot of people in their life, they don't talk about their why much at all. And it's actually the center point for anything that I do, because we need to be able to not understand just what it is that we're doing, but the why is important, because a lot of times when we figure out what that is, we can really start to go, well, maybe I'm just doing this because my parents wanted me to get into it. Maybe it's not something I'm passionate about. Maybe I'm doing this because I thought it was a good idea, early on, but now I'm not so sure about that, but I just keep doing it because it's what I've always been doing. There's a lot of different motivations behind a why. And to give a very clear example, I always like to use a house. People will all be like, what's your goal? And they'll say, hey, I want to buy a house. Okay, that's great. That's a nice what? That's the goal. But why do you want to buy a house? Well, I want to buy a house because, I want to move into a, safer neighborhood and better schools. Okay. Why do you want to buy a house? Well, I want to buy a house so I can move in, flip it, and then, turn it around and then move into another house and do that over and over again. And now it's an income producing thing. Oh, okay. Why do you want to rent a house? Well, or buy a house? Well, I want to get a house and I want to have an extra bedroom that I can use as passive income to rent it out as an Airbnb. Same what, lots of different reasons why. So it's the same thing with investing. You need to understand, why am I investing? Am I investing for retirement? Am I investing for cash flow on a monthly basis and you want to be able to pay off a couple bills? Am I investing? What is it? Because ultimately the why should be the thing that drives the what. And a lot of times we do that backwards. So it's really helpful, specifically when it comes to a stocks perspective, to understand what your why is, because there's a lot of different stocks to choose from. There's a lot of different ways to buy stocks. You can buy options and calls and puts, or just shares of the stocks. And there's all these different things. But when you understand why you're doing this, well, I just want to, try to see if I can beat the market, with options. I want to take more risks, or, I don't want to worry about this stuff. But I know I need to be investing. Okay, that's great. Here's some nice ETFs or mutual funds for you. So when you understand the why within, if you start there and go, why am I investing? Then we move into the what should you invest versus doing it the opposite way, going, well, what should I invest in? And then figuring out the why later, or completely ignoring it.
Right on. I want to turn this to the audience here because I kind of like to get them involved. While I'm going to ask Stephen here a question about what his why is, so I'll let you think on that for a second. To the audience here, why don't you put in the chat here, what is your why? If you're willing to share, that'd be awesome. I'll kind of call some of these out, but why don't you take it from here? Tell us what your why is, and then I'll go after you.
No, it's great. So the great thing about your why is that it changes. So if you would have asked me this question 5 years ago, my why was just, I want to stick as much as my money as I can. 5 years ago, just had my first kid, and I was like, I want to stick as much money as I can into growth stocks and fairly aggressive ETFs, because I want to take on some serious risk at this point in my life, because I can. I had extra income. I didn't have a lot of liabilities or anything like that, and I just wanted to try to get the most bang for my buck. So that's what it was back then. Now I'm investing a little differently, and I've shifted my strategy for the short term into cash flow. So now I'm like, okay, we're going to move my assets around a little bit, and I want something that's a little more stable, a little more cash flow as I'm building this business. So that's one of the big things that I think a lot of people don't understand too, is it's like, you've got to evaluate this every, year or so and understand what your goal is going to be. So for now, like I said, it's a little less risk averse. I'm still, compared to the average person, I would still be considered high risk, but compared to the stuff I was doing before, I've definitely got a little more conservative with it and
Sure.
focus a little more on cash flow.
Sure. I love it. That great backstory there. I'm going to jump to our chat. Really good,
Oh, we
very
got some good
motivating
stuff.
here, guys. So, Nitin said wealth building mainly to build up a retirement in 5 to 6 years from now. Awesome.
Okay.
Nav wealth preservation for the majority of my money, but with growth, don't need cash flow. Nice. Okay. More focus on growth. I see John to leave an inheritance for your children. Awesome. I see Mustafa to build a good portfolio for retirement. That's great. Wealth preservation. I see Aaron have less than 50K for retirement at 53 years, but got a long way to go and a short time to get there. So individual stocks are your play. So we'll help you. We'll try to do our best to help you out today. Nav, moderate risk, and then nice, Elizabeth. I'm with you. Travel. I like that. That's a good segue to my why. It was between 2006 and 2010, I was building an agency, was a service business doing websites and software for small and mid-sized companies, working like 60 to 70 hours a week during the recession, making no money. And it was really good experience that actually kind of paved the way for what I do now. But after we did go through a merger in 2010 because we started bringing on some bigger brands, but I was like, a part of me was like, gosh, I wasted 4 years like making no money and building no retirement. But I learned a ton. So I wanted to flip the equation to how do I move myself closer to financial independence? And I started investing in some private tech businesses, and I didn't make like any money there as well. I found the best solution. And there's so many ways people talk about to make money online. I I haven't tried them all, but I'm very aware with so many different facets. And honestly, the easiest path is investing in the stock market, those individual stocks, Warren Buffett style. So yeah, my why is financial independence, retirement. Fortunately, I'm with Tykr full time now. Took about 3 years, so I love what I do every day. But yeah, essentially is to travel more eventually someday and maybe play a little bit more golf. But yeah, I do like my free time. So yeah, that's the good or that's the why on that first point. Let's transition to, we'll both touch on this one, then I'll probably talk a little more about 3 and 4. But with number 2 is, where should you start? So why don't you tell us, Stephen, where did you start when you got started with the stock market?
Well, I did what a lot of people do, and my first stock, I'll never forget it. It was Las Vegas Sands. It was 2009, a little bit of a financial crisis on our hands.
Mm-hmm.
And I knew nothing about stocks, about the stock market, 401ks. Again, I just graduated college, started a job. All I knew was back in this financial crash was that everybody was really stressed out. And I didn't really totally understand why, because I didn't have any assets to my name. I was broke growing up. So I wasn't really affected. My 401k wasn't tanking or anything
Sure.
like that. So I didn't quite get it. But I started to learn as time went on. Well, my first stock, Las Vegas Sands, this guy just gave me a tip. He was a big Vegas dude, and he's like, "Man, this thing's gonna come back." I think the stock went from like 140 a share to like $1.90, and I think I got it at 210. And it was like, it's either going bankrupt or it'll rebound. So I ended up buying it, making 100%, and then just sold it because I didn't know better. I was like, man, I put $1,000 in and made $1,000 back. This is easy. This is fun. I like this. And it's kind of like when you go to the casino and you win that first, couple hands, and you're like, oh yeah, gambling's great. Like I got
Mm-hmm.
this. And, all of a sudden you don't have as much money as you thought you did. It was kind of like that. So then I started buying other stocks, lost some money, and realized, okay, apparently it's not as easy as it sounds. Like I need to figure out what I'm doing here. So
Sure.
that was actually my first stock that I bought. But like I said, I wouldn't ever recommend that. I kind of see like it's a hierarchy with risk. So if anybody's going to tell you if you don't really know anything, but you're going to buy something today, buy a mutual fund, buy an ETF. That's the easy, lazy answer. If we're going to go with, but what stock do I buy? Well, that's pretty simple, in my opinion, anyway. Buy a stock of a company that you love.
Yeah.
I have friends that are, and I'll probably use this as another example for number 3, so I'll just say it now. But Disney. I live in Florida. We have Disney parks, in Orlando. I have friends that they got engaged at Disney. They take their kids there. They got the annual passes, all this other stuff. Big Disney fanatics. And I enjoy Disney. I lived in Orlando and growing up and all that too. So it's like I have a pretty good understanding of that company, not because I just go to the theme parks, but I consume a lot of their stuff. And then the fact that I pay attention to it. But that's what I would do. Do you love Apple in your iPhone? And do you have an iMac? And are you sitting here going, the past few iPhones have kind of been the same thing. And, they haven't really come out with a cool product since the AirPod. And there's not a lot of innovation. Are they stagnating? And, when you consume a company, it's easier to then ask a couple low-level questions and then Google search some very basic data. And then you can kind of get an idea of where that company might be going. So for me, start with what you consume.
Right. Love it. That's Warren Buffett advice too, is like invest in what you know.
Mr. Coca-Cola.
Exactly, right. Dairy Queen. I know Dairy Queen is not a stock, but it rolls up under Berkshire Hathaway, the stock you can buy. But in my case, I know tech really well. My audience has probably heard me say this before, but I know tech really well, but I don't know pharmaceuticals that well. So I tend to avoid pharma. And another reason why is government regulations can cause a stock to go up and down overnight. That'll give me a heart attack. I'm going to avoid that.
I'd stay away from pharma for that exact reason. I do not know that world well. I know people that do, and I'm like, dude, all I know is like one FDA test, and it's just boom, done,
gone. Cut the share price in half. So no, thank you there. So I invest in what I know, but real quick here, I'm going to dive into where I start. I'll actually show my screen, but if you guys could, real quick, let us know what your first stock, if you have bought a stock. I know some of you are probably some of you may be in the learning phase, so you're kind of ramping up to buy your first stock. But if you have bought a stock, I'd love to, or Stephen and I would love to see what you bought. But my first stock was actually PayPal, going back almost 10 years ago. So I have held that stock for the longest. Second would be Microsoft. And the reason is I know a lot about both companies quite a bit. So why don't I show you guys something here? Disney, nice. Michael went Disney 30 years ago. Cool. I'm going to be peeking over here in a bit.
I'm giving everybody my ticker in the chat too, so they can go look it up. Like I said, I had shares at like $1.90, and then you guys can go look it up now and tell me how much of an idiot I am.
All right, let me share my screen. So I don't always do this, but we're going to jump over to our development environment. They say you shouldn't. They say you shouldn't show your dev environment to the public until it's really thoroughly tested. I did some testing today, but I'll show you guys. This is a new 4M. But first things first, let me give you just a high level of what the 4Ms are. We'll go to Apple. We'll start there. So you guys may see this layout is a little different. We've got the score on the left and the margin of safety on the right and the 4M in the middle. So I'll give you context here on where I start. I always go to Tykr, and right away, whether I'm listening to a podcast or I hear somebody say something on YouTube or my next door neighbor makes a recommendation, and I always say this and I recommend this to you guys, if anybody tells you to buy a stock, the last thing you should do is buy that stock. The first thing you should do is ask why, and then you stop and you wait for them to answer the question. In most cases, they won't have a pretty good why. So what I do is I go to Tykr first, and number one, I look for that summary to understand if is it on sale, watch, or overpriced. I wanted that when I created the Excel sheet way back. I wanted kind of like that green light, red light decision making, like you're sitting in your car at the stoplight. That's essentially what that is. So I look for on sale stocks. The higher the score, the safer the investment scores between 0 and 100. And then the higher the margin of safety, the higher potential returns you can make. So that's my starting point. That would be, you would get those 3 points, that summary, score, and margin of safety, really roll up to that first M of the 4 M's. The first M is the margin of safety. It's called that. You could call it the math part as well. And then I move on to the meaning, moat, and management. I'll kind of define those, and I'll give you a little demo what this looks like, which is powered by ChatGPT. But the meaning is the business model. How many revenue streams does the business have, and how scalable those streams are? And when I say scalable, you want to think about companies that can increase revenue without increasing liabilities as fast. The biggest liability would be payroll. So for example, like a software company, you can sell software licenses. You could sell like 1,000 or 10,000 overnight, and you don't have to hire 10,000 people to support that. You don't have to increase your liabilities as fast. So we like scalable revenue streams. So that's the meaning. The moat is how the company stacks up against other companies in the same sector and industry. You want to create a wide moat. For example, like Steven mentioned earlier, Coca-Cola, when you go to the gas station and you want a cola product, in most cases, you're probably going for Coke or Pepsi. You're not going for all the off brands because of that brand moat. Same thing for like a tissue. You're probably going for Kleenex. So we like our wide moat. And then management would be the track record of the CEO. I use this analogy all the time. Sorry to those that don't follow American football, but if you're the GM of a football team and you want to win a Super Bowl, you can either go to the local high school to find a quarterback, or you can go find a quarterback from another football team that has already won a Super Bowl. You want people that have been there, done that. So without further ado, let me show you guys what this looks like. The current 4M that's live is manual. It can take 5-10 minutes, maybe longer to go through, but with ChatGPT, it's going to do a lot of the homework for you. So let's go ahead and do that. We're going to take a look at Apple. And you can see here, let me grab some water here. Losing my voice.
And by the way, while you're taking a drink, you can call it soccer now, because when America beat England in the last one, I think they seceded the right to call it football over here. So we win.
Right. All right. So this experience is kind of gamified as well. So the first screen, like I just summarized, you understand what the 4Ms are. Those are just defined. We'll click Get Started. And then here's what we're going for. This is for those of you that find that, let's say, on sale stock, but you're not quite sure if it's a buy. Well, we call this the 4M confidence booster. So we're aiming for a score between 80 and 100. Moderate confidence is like between 60 and 79. You should know the company pretty well and have strong conviction, and then you can still invest. But anything that's really 59 or lower would be low confidence. You should probably go look for other stocks. So let's see what we end up with Apple. All right, so the first screen here, that margin of safety, again, that's the math part. It just kind of displays what that score is along with the margin of safety, and then that summary. Now, this is where things get fun. This is where ChatGPT does the hard work, so we don't have to. So you can go ahead, click this button, and ChatGPT will go to work. This could take a few seconds, but we'll just give it a minute. All right, here are the revenue streams. iPhones, Apple Music, Apple TV, Apple Arcade, nice software, cloud services, iCloud. Yep, it kind of lays out everything for you. Revenue scalability, we've got, in this case, this is high score. This is a highly scalable business. I've been an investor in Apple for years. I like this company because I'll just kind of summarize here. You have the iPhones, you have the tablets, you have the MacBook. I'm using a MacBook right now. I've been very impressed with those M1 chips. What I'm really impressed with is the services side of the company generates about 20% of the revenue. In the services side, there's no hardware products against it. So it's that, you can see up here, like the Apple Music, the App Store, Apple Pay, all falls within it. You can generate revenue without moving a physical product. I do mention this to other people out there. When you invest in like electronic vehicle manufacturer, Tesla, there's a lot of plastic and metal to sell one unit. And if you get any disruption to supply chain or manufacturing, you can cause issues to your revenue and, of course, your profitability. So it doesn't mean it's a bad company. It's just I tend to gravitate towards companies that can scale revenue. You don't have to worry about hardware so much, but Apple has a nice mix between hardware and software products. But anyway, we'll keep going here. All right, next up, we do compare against the S&P 500. This is using alpha. If you guys ever click on a stock in Tykr, there's one of the tabs. You can see like financials, earnings reports, a bunch of details, but alpha is one of those tabs. So we like to see companies that actually outpaced S&P 500. All right, we'll go next. Here's one question you need to answer yourself. This relates to how well do you know the company? So in this case, I would say I know the business very well. We'll go continue. And this right here, what you're about to see, it might not show all the competitors, but it should show a few. And it's really comparing not so much against competitors, it's against other companies in the same sector and industry. And what this tool does is, so you guys know, it's crowdsourced. So every time it's completed by one of you, it gets a different list of stock to compare against. So the score becomes more rigorous. So if like Steven were to do this after me, he would see different stocks. But anyway, let's click this button and see what we get. All right, so we just get about 2 here. It should show about 4 or 5 other companies. Let's keep going here. What it does is it compares that summary, that score, margin of safety, the revenue scalability, and that alpha, and just to see where they stack up against each other. We'll go next. And then we want to analyze the management. We're almost done here, actually. All right, so AI is going to go to work. Let's see what we get. Leading Apple to be a trillion-dollar company. Nice. Overseeing successful launch of groundbreaking products. Apple services, that's big. Yeah. And again, high impact on the company. And the last tab here, this is pretty cool. Just so you guys know, I'm hovering over this little tooltip. We do look at Glassdoor. The reason is statistics have been brought to the surface on companies that have a 3.7 out of 5 or higher actually outperform the market by about 6%. And then stocks with a CEO approval greater than 73% can outperform the market by 8%. Not in all cases, but in a lot of cases it does. So what you can do here is you could actually skip this screen if you really wanted to, and we will use the average that's been applied behind the scenes for this stock. I'm just curious here because I like to jump over. And Glassdoor, if you guys don't know, it's a free site.
And Sean, real quick, to add some additional context to that. So Glassdoor is where employees self-report, how working at this particular place, is going. Now, one thing that it can also do is if you see the scores that it has had over a certain period of time, like for instance, Salesforce, where I used to work, was always pretty highly rated up here, correlated pretty well with strong stock performance. But then what ended up happening is Salesforce score started to drop. And for the first time in like over a decade, they weren't in the top, I can't remember what it was, 20, 25 companies. And what ended up happening, and a lot of the reason for that was because they were over hiring. There's a lot of bloat, and a lot of salespeople report on Glassdoor because they want other salespeople to know whether or not, the commissions are unfair. They're saying you can earn this much, you're not going to, stuff like that. And then what ended up happening? Shortly thereafter, they had to lay off like 9,000 people. Stock price started tanking, all these other things. So you can't, I'm not saying that's always going to be an indicator for it, but if you see a place that has a history of really good Glassdoor scores, and then it really starts dropping for some reason, that could have an interesting indication of something that's about to go on within the company and therefore the stock.
Yeah, good call out. Cool, I'm looking here, 4.0. I like to see stocks that have a 4.0 or out of 5 or higher. And then I'd like to see an 80% on that CEO approval. Mark Benioff is 76, so pretty close. Comparing this to Apple, you can see the 4.2, and then Tim Cook at 89. So what I'll do here is I'll just put in the 4.2. Let's go 89. And we'll see what score we get. We didn't get a lot of companies in that moat section, but as it should be launching hopefully in the next week or two, then this is going to build out a longer list. But let's see what we get. Nice, looking pretty good. So we wanted to go for 80 or higher. We're at 86 with Apple. So, and this is, we've done doing testing on this for at least 3 to 4 months, and getting that score 80 or higher is actually really tough because we really wanted this to be difficult to find those strong stocks. So going back to my starting point, I'm going to close this as mentioned earlier. We'll go to that Tykr rating. I like to start with that summary, then the score, then the margin of safety, and then let's finish it off with that 4M, see where we end up. And if I can get that 80 or higher, that gives me enough confidence that, hey, I've got myself a strong overall company, and I can move forward with buying that stock. All right, before we jump on to how to see if a stock is a strong or weak stock, I'm just looking at the list here. So Elizabeth, you mentioned AXP, so American Express and 3M. Nice. Let's take a quick look here. I'm going to see what these look like in Tykr.
3M's I think they still have dividend king status.
AXP, AXP. I thought that's American Express. Yes, it is. All right, 72, that's a watch. That margin of safety, we want to see a touch higher. For those of you that don't know how this works with Tykr, on sale is a stock that has a score of 50 or higher and a margin of safety of 50 or higher. Warren Buffett, even his teacher, Benjamin Graham, have taught us, gosh, this is going back 100 years now. You want to look for stocks that have a margin of safety of 50% or higher. It's like, as Warren would phrase it, it's like buying $10 bills for $5. That's how he phrase it. So American Express, pretty good score there. Let's look at 3M. I think a 3M paper. That's what comes to mind. 44. See what your turns are at. Negative 27. We'll go into some stocks later on. I see negative 50 over the years, but yeah, we could talk about this later. That's good to know. I see, looking at the list, meshing the GBT within the site is very cool. Thanks, Elizabeth. Love to see the glass door on Starbucks right now. Yeah, let's just take a quick look here. 50.
Sean, out of curiosity, and maybe the community knows this, but on here, when you have one like a 3M, stock prices and everything, because I know they like to pay out a pretty fat dividend. If I wanted to see what the dividend was on something, where does that pop up?
Sure. Yeah. So one that jumps to mind with a pretty high dividend is Caterpillar. You guys could go to two different places. You can go to details. You can see your dividend yield, dividend right there, dividend of $5. It's pretty good. You can go to your dividend calendar. This is kind of cool. You guys haven't seen this. You can see the
Shows it when it's coming out. That's nice.
yeah, yeah. And then on the stocks page, people do use this where you get a little inside tour here, the tool. You can add columns, like for example, yeah, let's go turn on dividend yields and dividend. And then you can reorder these. Let's bring them closer to the front. And then you can actually filter by those. That's what you get, Sean, for playing around on Dev. I think it crashed out on me. Let's go back here. It's gonna arrange. Yeah, where are my dividends? Yep, here we go. Dividend yield. I love this. You can put whatever order you want. And then let's say a dividend. We saw Caterpillar at $5. Let's say we want to find stocks between $3 and $5. We'll just click apply. Let me unsearch. I had it filtered by ASX. So we've got about 30,000 stocks in Tykr as of today. The game plan in 2024 is double that, go to about 60,000. But if you guys are looking closely here, you can see that filter, it took it down from 30,000 down to about 1,000 stocks. So if you really are into dividend investing, there you go. And then you can save your filters here, so you don't have to go recreate. All right, so looking back at the list here, I saw Mustafa GE for 30 years ago. There you go. That's a company I used to work for, actually. Isn't the fair value set by the top analysts of Wall Street? Aaron, so fair value for context there can be calculated in multiple ways. With Tykr, so you guys know, we really used what was inspired by it. I'll just do a quick search here so you know who the guy is. Phil Town. There's the um, there's the Graham formula, which uses the share price growth rate. What Phil Town, and this is why I like his formula better, is he uses the EPS growth rate. The reason I like EPS more is share prices can go up and down based on emotions. We saw that with GameStop, AMC costs a few years ago. That's not a reliable indicator, but EPS, that's the profits of the company. So you cut right through the clutter and we look at that growth rate. So we use the EPS growth rate. You can use Graham, but we found EPS to just be more reliable. There are other ways, but those are like the two common ways. When you have a positive indication from Tykr like you did from Apple, do you go out and buy immediately, or do you look at the general market conditions and wait to buy if the general markets are selling off? Great question, Nitin. We're getting into more detail here. We'll touch on this at the end. So I I like this is a stockpiling technique. This is the number one most important strategy with investing, which is you want the market to go down. Like for example, in COVID, the COVID dip of 2020 was actually February, March. The market went down like 30%. Well, I stockpiled, and stockpiling, if you guys don't know, is a strategy of keeping money in your broker. And then what you do is you buy into the dip because nobody can actually buy the very bottom of a dip. You buy like every 5 to 10% down as best as you can. And what I typically do is I don't get to less than 20% of my account. So I'll use nice round numbers. Let's say I've got $10,000 in my broker. I won't bring it down to $2,000 or less because I always want a little dry powder available cash to buy in case it goes down more. So I actually like when the market pulls back a little bit because in most cases, there's nothing wrong with the companies we're investing in. It's just the market, like 2022, recession, pulls everything down. Bam, that's your opportunity to strike. That's when you buy, and that's where you make the most money. That's probably a hot tip number 6 out of the 5 tips today is stockpiling is the most important strategy. And actually, Aaron, you mentioned about accelerating your process. When the market starts dropping, that's when you want to attack. If you wait for all the positivity in the world, you're buying when it's high and you'll make decent returns. You can beat the market, but where you really make the big returns, like for example, in 2020, that COVID dip, my returns that year were about 120%. Now, I won't get returns like that every year. I usually get between 15 and 50%, but you need a big pullback to strike when the iron's hot and then see that correction. And that's where you make the big returns. Like, for example, in 2022, I rode that portfolio way down. You got to ride the roller coaster down. It can hurt a little bit, but don't sell. And then you want to buy more and watch that take off. So my returns this year are probably, gosh, they're getting close to that 120%. They're over 100% for the year. But I'm not, just to preface here, I'm not going to see that every year because we're not going to have a recession every year. All right. How to see if a stock is strong or weak. I want to show you guys something real quick here. And I always say this just to be transparent, you don't need to use Tykr. Tykr can save you a lot of time. It's got a lot of cool tools in it, but I always like to let people know there is a free way to do this. You can go to like MarketWatch or Yahoo Finance or free sites. Investing.com is another option. These sites are riddled with advertising, so you have to put up with that. But an example would be if anybody, again, out there, we're going to go to Netflix. If I could spell Netflix. There we go. If you ever hear anybody and you're not using Tykr, anybody says, hey, go buy this stock, here's how you quickly find out if this is a stronger weak stock. What you want to do is go to the financials tab, and any of these sites is going to have the same kind of phrasing. So you look for financials, make sure it's flipped to annual. And then what you want to do is you'll get a really good idea by looking at that income statement. What Tykr does, so you guys know, we look at the income statement, cash flow statement, and balance sheet. But you, in this case, you can get a really good idea, like if this is a strong stock or not. What you do is go to the income statement. You want to look for 3 lines. So if you got a pen ready, this is your chance to write down. You want to look at sales and revenue. That's number 1. Number 2 would be net income. Number 3 is that EPS, which is earnings per share. Essentially, the calculation of earnings per share is net income divided by outstanding shares. So the story of net income and EPS will be very similar. But anyway, looking at Netflix here, this is cool. You're going from left to right for about 5 years. Some of these sites might be like 4 years. Don't split hairs on this. You just want to see how things are going. So check this out. We go from 15 billion up to 20, up to 25, up to 29, up to 31. Perfect track record year over year. You're not going to see that with all stocks, but this is really good so far. Now let's go to net income. See how things are looking. All right. And these are the 3 most important lines on the income statement. All right. So we've got 1.2 billion up to 1.8, 2.7, 5.2. Little drop off there down to 4.9, but that 4.49 is still greater than 2 years back. So we're almost perfect in that case. So still looking really good.
Hey, Sean, just for fun, type in Uber real quick and do this.
Type in which one?
Uber.
Ooh, okay.
Because there's something that is kind of important. I think we're going to see on the Uber one that people may or may not understand about how stocks kind of work.
Sure.
To a certain degree.
And then
so,
I'll jump to Uber real quick here. Let me just finish with EPS.
No, go ahead. Yeah.
Yeah. So with EPS, guys, you've got $2.78 and up to $4, $6, $11. Then again, very similar story to that net income. So you see that little drop off. But as you can see, overall, this takes you about 60 seconds or less. You can quickly see like, oh, okay, so those numbers are increasing year over year. And that's what large institutions, which are the companies that really move the market up and down the most. It's not retail investors like you and I in most cases. I know GameStop was a different story. But in most cases, institutions, they want to see those numbers increasing quarter over quarter and year over year. But anyway, let's jump to Uber. Let's take a look here. All right, financials tab. We're on annual, we're on net income. Let's take a look at sales. All right, so we're at 11.2 up to 13, back down to 11, then up to 17, then up to 31. Whoa, that's pretty impressive.
Everybody was ready to get out of the house.
Yeah.
The pandemic.
You're right. Yeah, good, very good.
That was a huge trend point, and they raised prices on top of it.
Yes. Let's take a look at revenue looking really good, but here's the issue. Check this out.
Yep.
We've got net income, you're positive, almost $1.997 billion. Then we dive into 8.5 billion. Ouch. Then an improvement up to 6, an improvement up to 496, but then way back down to almost 10 billion. That right there, we're gonna actually, let's just go to Tykr and see what this looks like.
While you're pulling it up, the reason I wanted to show that is because there are, specifically with technology stocks and ones that are technology adjacent, like Rivian, for instance.
Mm-hmm.
These were hot. Everybody was talking about Uber. Everybody was talking about Rivian when they IPO'd. I stayed away from them like they were the plague, despite the fact that everybody was sort of hot on them. Why was that? Well, it really just came down to one really important stat. They weren't profitable. Now,
Right.
Being profitable, specifically in tech with growth companies, it does not necessarily correlate to the fact that a stock is going to go down, because a lot of times they are going public in order to raise capital, pay off previous investors, different things like that. So they can still be losing money because they're burning cash that they have, in order to grow quickly. So you see that in a lot of stocks like an Uber, they're burning cash to try to grow quickly, knock out competitors like Lyft, different things
Right.
like that, gain
Yeah.
market share. But what you have to be careful of in those situations is don't become too comfortable with buying a stock that's going up, that's operating consistently at a net loss, because like what you're seeing with Uber, if anybody's ever taken one recently on the product end, right? Again, thinking like a consumer,
Mhm.
I don't take Ubers that much anymore, whenever I'm traveling. Why? Because they're more expensive than taxis. Well, the entire reason I started using Uber was because they were cheaper and nicer than taxis, right? And if it's, close comparison, it's one thing. But the point is, it's like they started off and they could subsidize their prices so cheap to gain market share because they had all this cash they could burn because the investors were giving it.
Mhm.
Now that the investors want their money back, they have to raise prices. It's the same thing with Airbnb. You're seeing that if you try to book an Airbnb, it's ridiculous what you pay in fees. So it's important whenever you see a stock and you're looking at these things, earnings per share, revenue, all these other things, if you see one that's in the red from that net income perspective, but then you're like, well, the stock's going up, just know that that could be the fact that, yes, they're on a trajectory towards profitability, but that's just part of the strategy. So what you just want to see is that red number getting smaller and smaller on a
Yes.
year basis. That's really what you're looking for. So I just wanted to throw out that caveat because I know you love tech. I love tech. It's sexy.
Mhm.
Everybody loves tech. But in tech specifically, you will see that. So that's generally what I'd say you want to look for. Or you could just get a Tykr subscription, click on what it has to say, and it'll do
Right.
all this for you.
Right. Thanks for the plug.
No problem, man. I'll take my 20
I'll
bucks.
send me an invoice offline.
Yeah. I got the 20 bucks you promised. You got the plug.
Um, so with net income, as you guys saw there, this gives you transparency on how Tykr works. And if you guys haven't seen already, if you go to Tykr.com, we are open source. We're actually the only open source screener out there that I know of, where you can go look at the calculations, play with them in Excel. And we always tell people if you really wanted, you could go create your own version of Tykr. However, we hope you still stay with us. But jumping here to net income, you see those numbers in the negative and dropping. That's the big red flag that Stephen was pointing out. And if you go to the platform, that's why that margin of safety here is 0%, because the profitability is not increasing. Now, this score is pretty good. So just to look at how is that achieved? Well, the revenue we know is increasing, so that's a good sign there. But net income and EPS, since they're very similar stories, they're not going to be looking too good. So that probably tells us the balance sheet may be halfway decent. Let's take a look at the free cash flow. Free cash flow, just so you guys know, there's one line to look for. Scroll all the way to the bottom. Look for free cash flow. Look at that. We go
Yes.
from -2, -4, -3, now an improvement up to -743 million, and then +390. All right. Got some free cash to buy some other businesses or maybe invest in marketing. All right, last sheet here, balance sheet. There's 4 lines we look for here. We look for assets and equity to be increasing, and then debts and liabilities to be decreasing. So assets, we're looking for total assets. Let's take a look here. 23.9 up to 31, up to 33, up to 38, back down to 32. So decent 2022, kind of fell back to the 2 years prior. So not horrible, could be a touch better, but I would still say that net income and EPS were a lot worse. Now let's go to total liabilities. Biggest liability in a company will typically be payroll. Let's take a look here. So we're at 17, down to 16, so moving in the right direction, then up to 19, up to 23, flat at 23. So if you guys remember that first page, that income, the revenue was increasing a lot, liabilities not at all. That's a good sign there. Doesn't mean you should go out and buy Uber, but this is why that score is higher than 50. Let's go to debt, total debts. You have to scroll up a little bit. There's short-term debt and long-term debt you'll see on these. Short-term debt is any debt you need to pay off this year. Long-term debt is what you're looking for. So let's take a look. In most cases, these are bank loans. So at 9.3, down to 7, so moving in the right direction, then back up to 9, a little jump to 10, little jump to 11. So they're probably, as they're hiring more people, you got to take out bank loans to have enough cash available for payroll. All right, last line, total equity, manual look. Let's see what we got. 6.7 billion up to 15, down to 13, back up to 15, but then back down to 8. So not perfect. But yeah, I did see some positives here. The 72 would be a touch higher if that net income, that EPS, and that equity were a little better. But because that EPS, that profitability is dropping, that's why this is a margin of safety of 0. So that what you guys just saw there was like a look under the hood on how to kind of manually analyze the stock. But of course, Tykr does this for you. All right, let's jump to because I want to make sure we've got plenty of time for Q&A. We got to get to when do I buy and sell, and then how to stay disciplined. I'll hand that one off to you, Steven. So here we go. As long as I'm on a stock, we'll actually go to one of the Magnificent Seven. And there's going to be a YouTube video. Stay tuned for this. It may go out today or tomorrow, but it actually ranks the Magnificent Seven stocks I actually go in reverse order, 7 down to 1. I'm not going to give you guys any previews right now. You're going to have to watch that video. But NVIDIA is one of the Mag 7. Now this stock here, this is what I do when I buy a stock. So get ready, take notes on this one. This is how I buy and how I sell. So when I buy a stock, I look at two things. Number one, I want to make sure the stock is on sale. That's number one. I look at that summary. And number two is I want to make sure that 4M is an 80 or higher or pretty close. If it arrives at like 77, 78, I'm not going to split hairs on this. I'll go ahead and move forward. And the most important thing is it's not buying and selling, it's buying and buying more. One of my favorite case studies, you guys may know this one if you're in the Tykr community, it's a guy by the name of Ronald Reed. He's a janitor who built up a portfolio of $8 million. The question is, how does somebody who's making close to minimum wage become a multimillionaire? The answer is being consistent in buying really safe businesses month over month. Don't skip a month. He was disciplined and he just bought the really strong stocks like GE, Johnson & Johnson. I think CVS Health was in that list, but he did that through the 70s, 80s, and 90s, and that's what got him there. So when you guys are investing, you should be finding that strong stock. I have 10 stocks in my portfolio. Don't get 30 stocks. You want to keep it focused to about 10 to 15 stocks and keep buying more every month. Just stay disciplined. So that's my buying point. Again, summary, on sale, and then that 4M 80 or higher. Let's flip that equation. When do I sell? So if I have a stock that flips to, let's say it flips from on sale to watch or overpriced, typically overpriced, and my 4M score is lower than 59, that's reason 2. And reason 3 would be, and this is really important, kind of like stockpiling, this is probably one of the most important things with investing, is to follow Rule 1 investing, which means Rule 1, don't lose money. Rule 2, don't forget Rule 1. And what that means is I never sell for a loss. When I buy and my stocks go down, I refuse to sell for a loss. I let the market lift those back up because you do get these springboard or slingshot effects in the market, kind of like we're experiencing now, that are lifting everything up. There's a phrase, the Motley Fool. If you guys listen to the podcast, they say a rising tide lifts all ships. That's what happens, that it lifts those stocks up, and that's when I sell for profit. So just to summarize again, switches from on sale to watch or overpriced, typically overpriced. 2, that 4M is 59 or lower. 3, I'm in the profit. I can sell for a profit. Now, if you guys don't already know, add your stocks to your watch list. Like you guys can see my watch list here. When anything changes on your watch list, you automatically get notified. This is my favorite feature in Tykr. I call it the set it and forget it feature. So I can go off and do whatever I want, and the tool will do the hard work for me. So I'll get a notification saying, hey, Apple just flipped from on sale to overpriced. Not saying that's going to happen, but then I can look and be like, uh-oh, well, maybe I should sell Apple before it gets worse. So that's when I buy and sell. Real quick here, I'm looking at, don't you get the same financial info from Yes, Aaron, I was looking at that, the financials tab. You are correct. If we jump to, here's another stock, Adobe, you're right. You get the three, we just showed the eight important lines to your income statement. You have your revenue, net income, EPS. Then on cash flow, we have free cash flow. And then on balance sheet, we do have the assets, liabilities, debts, and equities. But of course, if you weren't in Tykr, you could go to like a Market Watch or Yahoo Finance. And then Mustafa said, if you don't ever sell at a loss, then do you not do tax loss harvest? Good call. I don't always need to do tax loss harvesting. If you guys don't know what that is, this is really good for like business owners because you're always trying to figure out ways on how do I not pay Uncle Sam or pay taxes or as much in taxes. So one of my buddies was talking to me about this this week actually. He was actually holding 1-800 flowers, if you guys are familiar with that one. And he bought it years ago and it's just kind of been a dud of a stock. And I was telling them, if check this out, guys, just so you know, this is a seasonal business. Every December, their revenues spike. I do not love seasonal businesses. I want to invest in stocks that generate revenue, a lot of revenue all year round. I'm not looking for just holiday sales type businesses. So he got into this, probably wasn't the best choice, but I said, you know what you should do? Ride it up in 2000, late 23, 2024 as high as you can. Try to get to your cost basis. That's your average buy price and try to sell for profit. And then he said this, he's like, well, what if I sold to kind of offset taxes a little bit so I don't have to pay as much in taxes? I'm like, your call. I don't always recommend that, but that is a good call out, Mustafa. You could sell for, let's say you lose one, two, three, $4,000 loss. That's going to offset your tax burden. If you want to make that play, go for it. I don't always do it, but it is a viable option. I do say this. This is another key takeaway, guys. Don't train a bad habit. I've seen investors do this. They will buy a stock, then sell for loss, then buy another stock, sell for loss. So they're training a bad behavior. You want to make sure you flip that so you train a good behavior of only selling for a profit. It like becomes habit essentially. So just keep that in mind. If you start selling for losses, you'll be more apt to continue to do it. And I don't recommend getting in that behavior. All right, I'm going to jump to number 5, how to stay disciplined. I'll hand it off to you, Stephen.
Well, this is a little bit of area of focus for me because what I do in life, working with people on goals and different things is very much a part of it. Discipline is something that not a lot of people have and everyone can get. And I think that's something that, people go, oh, they were in the military. Yeah, they're disciplined, all this other stuff. Or, oh, this person, they're really good. They're an athlete. They're good at working out. Yeah, they're good at staying disciplined. And it's funny how whenever we view something, like that, we tend to, even though I think most people understand that discipline can be learned. I think anyway, most people would think that. We really just don't really know where to start, right? So the two ways to stay disciplined is this. You can either change your behavior, or two, you can create systems that totally bypass you in any involvement and therefore the requirement to be disciplined at all. And that's really what it comes down to. So what do I mean by that? Well, a lot of stock platforms will give you the opportunity to do like, do they call them drip campaigns? Sorry, I'm going brain dead. But basically, a lot of stock platforms, you can put money into your account, and then you can say, I want to buy 20 shares, 500 shares, whatever it is, every month, every week at the, whatever market value is. So that's one way to you just fund the account.
Set it.
You like the stock, boom, you stay disciplined. It has completely removed you from it. And therefore human error. Oh, I forgot one week. I was out on vacation, so I didn't buy this time. Like it will keep you, very honest and disciplined from perspective. So utilizing technology is one of the best ways to do it. The next best way to do it is to have accountability. So accountability is one of the greatest hacks out there if you are trying to succeed at anything. So perfect example is I have 2 friends who are also very interested in stocks. And this is something that we talk about regularly, literally daily. Like my wife laughs every time she sees like something's getting, on the stock market's getting hot and the messages start rolling in. Well, the great thing about that is it makes it a more pleasurable experience for me. And it's not just about investing anymore. Now it's about a community thing. And we're all trying to help each other. We're trying to learn together, head in the same direction. So those would be the two things I would say is number one, create specifically in areas like this, technological systems that will completely bypass the need for you to be disciplined. And then in the areas that you do, get accountability, find people in your life. And if you don't have people in your life, then go out online and find them. And that's one of the great things about our wealth building journeys is that they're a lot more fun and they're a lot more profitable when you're doing it with people who are like-minded as you. Doesn't mean you have to have the same amount of money as them. Preferably you get to hang out with somebody that has more money than you, right?
You learn. You learn.
Continue to learn from them. But nobody wants to walk on these journeys alone. And it's one of the main reasons we founded the community that we had is people just wanted to be in community with each other as they were building it up, building up their wealth. And it's a good thing to have. So here within Tykr, sorry, I keep wanting to call it Tykr. I don't know why. So, but here with Tykr and, other things, it's like you guys, there's people here on these calls. If you don't have anyone, reach out to somebody on the Zoom call and get started with them. Just say, hey, do you guys just mind WhatsApping or messaging back and forth? I would just love to see what you guys are doing. It can be as simple as that. And doing that simple thing of finding that accountability, people that you can just walk hand in hand with on this, I think you'll find that your measure of success will grow exponentially.
Yeah, I completely agree, is finding like-minded people. On that note, one thing on our roadmap for Tykr is to add a community feature in the tool. Right now we have the Facebook community, but the problem is people have to jump outside of the Tykr platform to Facebook. And that's not ideal. So we're going to be adding, it's like a Discord type UI UX interface. That'll be pretty sweet. You can have different channels, but maybe one of the channels should be accountability. That's an idea to put on the list. But that way it's like you keep each other on track. But so you guys know what I do is, and this is what we recommend in our onboarding, is try to send between like 15 and 30% of your income to your broker every month. If you can't get that high, that's okay. Start small, start, $100 or whatever it is, and kind of work your way up. But then what I do is when the money moves to my broker, I keep 50% saved for stockpiling events, because that's where you make your biggest returns, is that attack philosophy is when the market goes down. The other 50% I DCA, just like Ronald Reed, that janitor, keep buying stocks every month. So that's the strategy I recommend. Try to every month and treat it like, if you can't do it automated, like Stephen was talking about with your broker, you'll have to do it manually, but treat it like whether it's your mortgage or rent or cell phone bill or utility bill, you have to make the payment. And that's what Ronald Reed did. It's like, there's come hell or high water, I'm sending money to my broker. Like, I'm not skipping a month, and you have to treat it like that. And that's the discipline, because I see way too many beginners that they buy their first stock on month one, and then they wait 3 months to buy their second stock, and then they wait 6 months to buy their third. You're not going to do yourself any favors by doing that. You have to be consistent and disciplined. And accountability, that can be a big help. So
I have to just back up what you said real quick. The mindset shift that investing for your future is just as much of a bill as the electric bill.
Yeah.
It's seriously underrated when you really start viewing your financial foundation. Okay, I got to get money into the savings account. It's a non-negotiable every month. I've got to be investing into stocks and all this. I mean, when you view that like the electric bill, it'll change your priorities. So I just have to absolutely back that one up as well.
It's absolutely mandatory, 100%. Well, we hit on the 5 points how to invest in scary times, and we titled this as Scary Times because the world we live in now, there's a lot of conflict going around the globe. But just to give you guys context, and there's an article on Tykr on our blog that talks about, over the last 100 years, there have been about 19 bear markets / recessions, and the average duration is about 9 months. And this includes, we're talking 9/11, going back to the Saudi Arabia war of the early 1990s. through the assassination attempt of Reagan in the early 1980s, then JFK, going back to the 60s, then even going back to World War II. World War II is probably one of the longest, if I can recall, but what it reminds us is no matter what's going on in the world, the stock market, I hate to phrase it this way, but it doesn't always care, and it doesn't care that long. And the reason is, this is a big takeaway too. This was something that happened in November of 21 when the recession really started. The reason was the uncertainty of Russia attacking Ukraine. When there's uncertainty in the market goes down. But as soon as a decision has been made, whether it's good or bad, the market can take off. And we kind of saw a little bit of a spike. It was actually February of 2022 when Putin officially announced we're attacking Ukraine. That's when the market kind of took off. But at this point, it was already too late because inflation was going up and we had to raise interest rates to bring it back down. And we're also dealing with the COVID variant. It was Omicron at the same time, and it just, I call it a triple threat of things going on that just caused that recession. But when, again, just to rephrase that, uncertainty causes the market to go down, but as soon as a decision's been made, whether you agree with it or not, the market starts taking off. This happens over and over. So that's why it's good for us investors. We can be fearful, but it's not going to do yourself any favors. Think like Ronald Reed through like 2-3 decades. This guy, no matter what, he just kept buying more. A janitor just kept buying more. My favorite case study all time. And I've seen so many people do this. In fact, I've had people on my podcast that bought stocks during the 2008 downturn. And for example, one was Ford. A guy put in $100,000. He turned it into 2.5 million in about a year and a half. You can't do that every year. You need a pullback. You need the fear in the market to pull it down. There's nothing wrong with the stocks you're investing in. In most cases, that's the time to attack.
And if you're ever wondering what things are, because I know for me, about 3 years ago, I decided to just stop watching news altogether. And man, my life has been better since then. But,
Yeah.
it's like if you had a friend who lied to you 50% of the time and then gave you really bad information the other 30% of the time, would you hang out with that person at all? It's like, no. So then why do you listen to the news? So, I do, I mean, the exception would be like a CNBC, and obviously I'm paying attention to markets and things like that.
Sure.
But in general, a really easy way to kind of figure out what you're doing, they literally track this. If you type in the fear and greed index, you can come up with a couple different things. It's based on consumer and investor sentiment. So they are, polling people saying, how are you feeling about things right now? And just as good old Uncle Warren, has taught us, you buy, or you're greedy when people are fearful, and you're fearful when people are greedy. So, what does that mean? Normally, when things are going great, I saw a question by Elizabeth. I think she's got to go, but this is going to tie exactly right into this. How do you affect or respond to the Fed changes? Well, if you go back, I haven't looked at the fear and greed index, in the past 24 hours since the Fed made that decision and stocks decided to just, full green candles everywhere. But basically, I'm sure that if I go and I look at the score a week ago versus the score today, that fear and greed index just went from, focusing a little bit more on the fear side, it just went to a lot more on the greed side. And because that a Fed change is exactly the type of thing that would make that swing, because it gives confidence that things are going to get better across the board. So it's not regarding any particular stock, but the market as a whole. So it's a great time because it's hard. The best investors I know are just robots. Fidelity, they did a report on this a couple of years ago. Their best investors were dead people who still had accounts because they didn't move any of their money, right?
Wow.
They were pretty impervious to what was going on in the market at the time. So I say all that to say that, Elizabeth, the way that I respond whenever the Fed changes or there's, peace or war happening or whatever the case is, I just go, how does the masses feel about this? This is, again, not focusing on a particular stock. This is a general outlook. I just say, how does everybody else feel about this? Is everybody greedy? Okay, then I want to sell. Is everybody else feeling pretty freaking scared right now? Okay, now I want to buy. And that is as simple of a way as I can say when something like a Fed change happens. I tend to do the opposite of what everybody else is doing.
Yes. Yeah, that's wise. And on that note, and Elizabeth may have dropped off already, so she'll see their YouTube recording, but for everybody else, looking at 2024, we went from inflation in 2023 that was as high as like 7, 8, could have been close to 9%. And we're at today, I just checked, we're at
I think it, yeah,
3.1.
almost peaked at 9.
Yeah, 3.1 now, and we want to be between 2 and 3. So that's why the Fed hasn't the last few times has not had to increase interest rates at all. And so you guys know out there, they're an inverse relationship. When inflation is rising, you have to raise your interest rates to drive inflation back down. And we saw the same thing happen in the early 1980s. The Fed chair at the time was Paul Volcker. He was the Jerome Powell of today. He had to do the same thing. And there are other things that were tried that did not work, like playing with taxes, like raising and lowering that. Throttling that up and down doesn't really make a big impact. But the interest rates, that proved to work. So it was like the market, you may hear this on podcasts out there, especially Motley Fool. If the market doesn't always repeat, it rhymes. And so you can kind of look at events in the past and be, kind of connect the dots. That's very similar to today. So I was looking at 2022 as very similar to the early 1980s. So long story short here, 2024 could be a pretty good year for a lot of investors. I would love to start jumping into some of these questions here. Nitin, you had a really good one. Let's say Apple turns to overpriced and it's one of your stocks that you want to invest. Do you stop buying until it turns to on sale? In most cases, yes, I actually do. For example, a stock I hold in my portfolio right now is Team. It's at Atlassian. I'll actually share my screen here. I will do in most, probably 80% of the time, that is the case. It will sit in my account and I'm not going to sell it until it becomes a profitable stock. I've been investing in this stock for a long time, not because of that first M. It doesn't really check the box. My background is probably close to 20 years in tech. And so like Atlassian has Jira and Trello and other project management tools. And with this, I'm like, oh gosh, so many big businesses use this. So the other 3Ms to me checked out the meaning, the moat, and the management. So I've made money on this stock, but I plan in 2024. So you guys know I've identified other stocks I really like, and I'll go into those. So I'm going to sell for a profit, go in, but I haven't really, to be honest with you, I haven't bought this stock in like probably a good year. But now, with that in mind, Nitin, if there is a stock I really have high conviction for example, Apple being one of those, I will probably still keep the gas down and keep buying more, especially because Apple is one of those businesses that I look at Apple, Microsoft, Google, those are 3 stocks I hold. They have so many different revenue streams within, and they've also acquired so many different companies. To me, it's just a no-brainer. I would keep buying more. Most companies don't have, like, for example, Microsoft acquired about close to 200 some companies over the last few decades. Alphabet, Google acquired close to 250, and those acquisitions turn into new revenue streams. Not always, but they can, new revenue streams in the business, which really creates a healthy business model. Because if you, and this is for some of you looking to invest in like a smaller company that's not so well known, it might just have one revenue stream. And if that is pulled out from under it, it's kind of like the legs of a table. If you pull the leg out, can it still stand? Well, if that revenue stream is pulled out from under it, it can tank overnight. So just keep that in mind.
If you want, I can take this one by Aaron because I have some unique background in this one. But
cap gains.
The selling a stock in the brokerage, or the cap gains one.
Cap gains.
So
go for it.
So
Yeah.
Aaron, this actually I learned a lot about this with Voyager. I was it was a crypto trading platform, publicly traded in Canada, pretty much the Canadian version of our Coinbase. And when they got shut down, one of the things that you learn is that when you have cash in your brokerage, any brokerage, whether it's stocks, crypto, anything like that, the cash is not actually being held by that company. they have a partnership with a bank in the background. So if you read the fine print, it'll actually tell you. So when you go to your E-Trade or, Fidelity or whatever it is that you're using to trade stocks, you will actually can see the bank that it is being held by when you have cash in there, because it has to be backed by a bank. So like I use E-Trade whenever I sell a stock, that cash is being deposited into Morgan Stanley, who, now owns E-Trade. So because of that, yes, it may not feel like it's your checking account necessarily that you've transferred it back to, but you technically have a bank account. And anytime you have converted it from, a share, an option, put whatever it was that you sold, and it goes back into your brokerage account, that is a taxable event. So it's always something to keep in mind that, yes, you will have to pay capital gains tax. The big thing is just understanding, obviously, is it going to be a short or long term? Don't be an idiot like I did and sell a stock at 11 and a half months because I thought I was over a year and turned out I wasn't. So
yes. Just to add on to that, Aaron, is what I do. I don't know if you use somebody to help you out with taxes, but I found it years ago. Just go through. I use H&R Block. I've had the same tax guy for like 13 years. I don't even worry about the tax implications. I use TD Ameritrade. So what I'll do is after the new year, it takes about a month or so, I think, with TD Ameritrade to give you the right tax forms. I'll just download the PDF and send to him. But I'm kind of keeping in the back of my mind if I do tax loss harvesting, which I talked about a little bit, but capital gains, honestly, I'm not really worrying about it. I'll let my tax guy deal with that and let it clean itself up. I sweep that one under the rug and let future Sean deal with it.
we literally, so not trying to plug anything, but like so in my community, we bring on a keynote speaker every month, and I brought on a CPA to demystify taxes. This happened yesterday. So this exact question came up, and he had an answer I thought was really good. He goes, look, he's like, death and taxes are the only things that are guaranteed for a reason. Okay. The government has been going at this for a long time. And he's like, there is no secret playbook. I was joking. I said, I'm in line to join the Illuminati so I can get access to that secret tax playbook. And he said, it's really simple. There's nothing that mysterious about the tax code. For the most part, they're going to get their money this year, or they're going to get it next year, or however long you defer it. They're going to get it. Yeah. Right. So his big message was, don't worry about it. Like, it's not worth the mental time and energy to like really worry about taxes outside of filing them, obviously. He's like, just take all that extra time and energy that you would focus on, like trying to figure out what the best way to get taxed, less is. And he said, put that into making more money. That's the solution to your wealth building problem there. So I just thought that was a really good, blunt answer coming from a tax professional. And he's just like, they're going to get it one way or the other, man. So if you just focus on making money, it will be time and energy much better spent than if we all sit here trying to pretend that we figure out the secret playbook to get around it.
Yeah, right. I agree. I don't really dwell on it a whole lot. I'm aware of it, but I don't spend a lot of time dealing with it. It's like I want to accelerate my wealth building process. A few more good questions here. I got plenty of time here, but one was related to, I'm actually looking at, we'll jump into some stocks as well. Greg, you mentioned Gregory, including index funds in Tykr. So for context there, we've got about 1,500 ETFs at the moment. The plan is when we move to about 60,000 stocks, we'll go from about 30,000 to 60,000. We'll get most ETFs around the globe, and that might include some index funds. I know they can kind of, sometimes depending on your data provider, it can include them in the same data bucket. So it may come with it. Just so you guys know, mutual funds, they're very similar. Like you've got ETFs, exchange traded funds, index funds, and mutual funds. They're essentially the same thing. It's a bundled product, can be 100,000 stocks, sometimes bonds mixed together. The idea there is if you invest in them, they're more for wealth protection, not wealth building. So you're probably going to match the market as expectation, maybe beat it a little bit, but set expectations, you'll match the market. Now, one thing to keep in mind, there's an expense ratio with all these products. Index funds and ETFs, it might be like 0.02 or I think like 0.2%. It's really low. However, with mutual funds, it can be 1.5 to 2%. It's very high. And I recommend people only stay with a mutual fund if you like your mutual fund manager, you like your service team. If they help you sleep better at night, great, stay with them. But just keep in mind you're paying a premium for pretty much the same returns. So that's my answer there on index funds. Jumping back up here, I'm looking. We touched on Apple. Yep. Fed changes. We could dive into a stock. I know Nitin, you mentioned ANF. All right, here's one for you, Stephen. You're going to laugh at this. Do you remember this company? Abercrombie and Fitch.
Do I? Yes, I do. Look, Abercrombie and Fitch, when I was in high school,
Yep.
90s, early 2000s, coming up like that, it was part of what basically became a class system in the United States. Okay. And everybody, is going, I didn't think the United States had a class system. Yeah. In the 90s, early 2000s, we did. If you were poor, you wore Aeropostale. If
Yeah.
you were middle class, it was Hollister or American Eagle. If you had money, or at least wanted to look like you had money, you
Look
wore
like.
Abercrombie and Fitch.
Yeah.
I don't make the rules. I don't know who made the rules, but those were the rules.
Sounds like we went to the same high school on the opposite side of the country.
I have a woman that is in, I just found this out the other day. There's a lady that's in my community, and her and her husband met because they were both models outside of the Abercrombie and Fitch store. And if anybody knows, those for the models, the guys would be standing in the middle of the mall in a pair of jeans with no shirt on. It was one of the greatest, weirdest marketing moves I think I've ever seen. They just pull these good looking dudes and yeah, you're just not going to wear a shirt in the middle of a mall and
Do
stand
that
there.
all day.
Thanks.
Yeah.
Oh my gosh, it's amazing. Only to then walk into a store and be hit by a cloud of cologne and perfume so thick you could cut through it. It was let's put it this way. It was such an experience that I saw they just did a documentary on this like a year or two ago. It was amazing. So yeah.
Yes, I have heard about that documentary, and my wife was actually listening to a podcast on some of the there's some issues going on behind the scenes with management, but I know Nitin, where you're going with this is you jump into this and you see, whoa, like what is going on here? This stock is on sale. It's got a 56 out of 100 and 88% margin of safety. And if you jump to the financials, we can see what's going on here. So the revenues are kind of flat, but what's interesting is, yeah, we saw a really big jump in 2022. Look like it's falling off a little bit here, 23, but let's take a closer look. So it does seem, looks like these financials on the quarterly side are a little ahead of the annual. This is why that margin of safety is increasing. It's that profitability is moving up and to the right. So really interesting. I don't know what's driving that. Maybe it's are more people shopping in malls. I know malls are kind of like a dying breed.
I
Or is
know that they just went through a pretty big rebrand, and because I think the a lot of the speculation around that documentary I pulled was that it was actually something that Abercrombie and them wanted out there to
okay.
kind of bring back the nostalgia as a branding move. So I think that they're really trying to reinvent themselves and come back, and that could be reflected,
Sure.
in the revenue from all their new marketing efforts.
Yeah. Um, Looking here at the stock. So, oh, wrong one. Let's go here. Close some of these tabs. There we go. So Abercrombie and Fitch. Yeah, the profitability is increasing. Jumping to the cash flow. I see a slight decrease here a little bit, but still much better than the quarter. It was actually April 23. The balance sheet is probably really what's keeping this thing alive. Let's go to yearly. A lot of green, a Liabilities are dropping a little bit. The assets did drop, but the liabilities dropping. Are they usually I think about, are they removing stores, which means you're cutting payroll, reducing headcount, maybe.
Instead, they have a new CEO who's very focused on cost control.
Oh, okay, good to know.
So that definitely could help.
Equity decreasing a little bit here. You want to see that increasing, but here's my opinion on like Abercrombie, like awesome. Okay, so the financials are improving and look at the returns on this 254%
Wow.
this year. That's whoa,
What?
that's
The
insane.
Moose. The Moose is on the comeback.
Oh
Dude,
my gosh.
you never would have been able to sell me on the fact that Abercrombie, first off, I probably wouldn't have even remembered it was a publicly traded stock. But like,
Exactly.
if you told me this year it was like a top performer, I would have laughed you out of the room.
Very, very interesting. Here are my thoughts on the long term, and maybe Stephen, you agree with me on this. Um, Going back to the 4Ms, the margin of safety, the math looks really good. You can check that box. Then I get to the meaning of the business, and I don't love retail, mainly because the moat is usually very narrow. Making clothing is not that difficult. Making an electronic vehicle is very difficult. Making a really state-of-the-art cell phone, an iPhone, that's really difficult. But making a pair of pants or a dress, that's not hard. So I don't see a wide moat in whatever clothing retailer. You can have a brand moat, but still that moat doesn't excite me. The meaning, like clothing, right away I think of, okay, it's again, my software side of me thinks about the scalability of tech. Like think of like I invest in Fortinet, cybersecurity. There's also Microsoft Office 365. You can sell a lot, not have anything physical to manufacture and ship. Whereas with clothing, you have to manufacture, you have to ship. If that's disrupted in any way, shape, or form, you can see a drop in revenues. And it's never going to be as profitable as tech. I also like payment tech platforms like PayPal. Transaction fees are great. You come between the buyer and the seller, you make money there. And then ad revenue. I love ad tech. Think about Google, Meta, Amazon, they make money there. So those middle two M's, like the boxes will probably never check for me. This is me, never check for me because of the business model. Sounds like the last M, that management is a nice change. That might be, I mean, he might be a really experienced guy. I don't know who this guy is, but so you got two M's that check, two that don't. But anyway, that's my thoughts on retail. Steven, what are your thoughts?
I like I'll play the devil's advocate on this one, right? Because I
Okay.
don't do a lot of retail, but I'll play devil's advocate on it. So I like retail from this perspective. It may not be a stock that I'm going to plan on holding for 5 years, but I could hold it for a year or two. When
Okay.
brands are hot, brands are hot. And in the day and age of influencer marketing, as this continues to go up, what people wear is very noticeable, right? We see the people that we follow, whether it's celebrities or, like I said, influencers, they're kind of the same thing at this point. And if a person's wearing something, guess what? Boom, sales are going to skyrocket. It's just we know this, right? So that's where I look at it and I say, okay, Jordans as a brand,
Yeah.
Nike, Jordans are only continuing to get more and more popular. I haven't had a pair of Jordans in probably 15, 20 years. I just bought 3 of them the other day because you want to know why? Not only are they in fact, I mean, people aren't even wearing them on the basketball court. They're collectibles. Kids
True.
don't want to walk. There's something called it's like the sneaker walk or something like that, right? Kids will walk funny when they have Jordans on, so they don't crease the top of the shoe to maintain
Yes.
like the way that it looks. I am seeing business people on stage wearing suits and they have a pair of Jordans on, right? So granted, Jordan is part of Nike, okay, but I know that brand is doing
Mhm.
well. I can sense again the consumer going back to I consume this. So if I'm looking at that, I'm going Nike
Hmm.
is only increasing in popularity. They're doing cool stuff with tech, with the apps and the running and all this other stuff, staying ahead of the game. They're sponsored with all the big athletes, yada yada. Okay, I'll buy into that brand. You know what I mean? If I
Right.
found out, I don't know this, but if I found out Abercrombie and Fitch got exclusive rights with Mr. Beast, and that for the next 6 months, Mr. Beast on his videos was, and again, I'm not saying he got to deal with them. Please don't
Of
hear that.
course.
It's
Yeah.
a hypothetical. I don't know this. But if I found out that he got to deal with them, well, that would really explain an uptick like that. And then I might go, okay, well, I know for the next 6 months, a year, however long this deal is
Sure.
that they have with Mr. Beast, this is going to be hot. That guy gets 200 million views every time he puts out a video.
Yeah.
This is big. So playing devil's advocate, if I am going to do retail, that's kind of how I would be looking at it,
Sure.
is more of a who is behind the endorsements of it and how big is that person's personal brand. And then I would really kind of, translate that to the potential success of the stock. I mean, I know he's not popular for a lot of reasons right now, but look what Kanye did for Gap. I mean, you want to talk about a dying brand.
Sure. Yeah.
So, I mean, there's a perfect example right there.
Yeah. No, good perspective. If you want to go for the short-term play, riskier play, right?
But did you see those returns this year?
I know you're not going to get those every year though, but for the steady, consistent returns that are beating the market over and over, I'm looking longer term. So yeah, Abercrombie, we'll see what happens the next year or two. I can't believe again that stock has taken off. I've got to um, uh, jump over to a few more stocks here, but um, real quick here, Aaron, where is Stephen Courson's podcast? So Payback Time is my podcast. You have a podcast, right?
I do. The
Yeah.
Stephen Courson Show. You can find it on pretty much any platform.
Okay, cool. Jumping back, I'm going to jump to Enphase. That was Gregory Smith. You asked about that. Jan Schuster. Hey, Jan, I know we've talked in the past. He's got a fun comment here. He never invests in airlines. Gravity is a bitch. Just takes one crash. Seriously. Yeah, there are certain businesses and industries. I mentioned pharmaceutical, one, federal change can cause that stock to crash. And like you said there, Jan, airlines. Yeah, I remember, I forgot what billionaire it was, but he made a hilarious comment. The fastest way to become a millionaire is start as a billionaire and then invest in airlines.
I like that. That's pretty funny.
Yeah, when I
Oh
read
gosh.
that, I was like, oh, that's gold. I'm saving
I
that.
mean, the only time to buy an airline was in 2020. I mean, it's the truth.
Truth.
You
Yeah.
can't even get free peanuts on there anymore.
Times have changed. Let's jump to Enphase because this is an interesting one that's really pertinent to the electronic, not vehicles, but renewable energy. So I've talked to other people about this stock as well. So you see this, like, look at this. It's on sale, really high score in Tykr and margin of safety at 90%. However, what in the world is going on here? They're down 60%. So there are really five things to look at when you run into this situation. Number one would be it's four or five, but anyway, looking at this, number one would be, is there anything going on in the market at this given instance that's pulling it down? I remember in 2022, people would be like, my portfolio's crashing. Like, these are all bad stocks I'm in. And like, no, they're not bad stocks. We're in a recession. And then I had to explain, the interest rates, the conflict between Russia and Ukraine, and then, of course, the Omicron variant that pulls the market down. So that's when you want to buy more. So we're not having a market issue right now. So that's not an issue. Let's jump to the financials here. This is something to pay attention to, Gregory, that it can cause institutions to lose confidence. These numbers look amazing. Like this is like right out of a PowerPoint if you're, doing a presentation to your board of directors or something. If you work for a company where that's your role, it's like, oh, perfect, hockey stick growth. You get to the net income, EPS, really looking good. I think free cash flow, same thing, looking outstanding. But then you get to, if you go to earnings per share and go to quarterly, this is the issue that can kind of turn institutions off. Doesn't mean you should run from a stock like this. It's just they're just having a moment. I remember PayPal had this moment as well a few times. This looks good here, but then when you're not seeing that increase continuously, it kind of flattens off. That's when institutions, they go looking at other stocks. So again, I wouldn't give up on Enphase, but it's like, okay, here's one reason why. Another reason why, and this happened at PayPal as well, which is guidance. And guidance essentially means your projections on your EPS and your revenue in an earnings report. Every quarter, you've got your earnings calls. If a CEO or a CFO or somebody says, things were looking pretty good so far, but we do expect them to not look so good in the near quarters. As soon as something like that is said, it drives me nuts. But in like institutions, they sell off right away. And that was a big part of this sell-off, was that expectation. We saw that with PayPal. It was Dan Schulman was the previous CEO. He made a comment. Things might not be so good in the next quarter or two, and bam, the stock just dropped. It's like it didn't actually happen, just saying it might happen. It drives me nuts. So I wish CEOs would never say that. So in this case, what I would do with Enphase, and so you guys know here, or you get a better idea what this business does. They've got solar panels. If I could, yep, these little chargers that sit in your garage. They've got inverters, which convert that energy. You could save it. Going back years ago, you would have to, like, if you had solar panels, you'd have to consume the energy right away. You couldn't save it. Well, with Enphase, you can save it. Yeah, I think this is playing into the renewable energy. I think you're going to be in a good spot for the long term if you invest. It's just getting a beating right now, unfortunately, because of things that were said and just kind of flattening off with those financials. So this does happen. It's just, if you ever see a stock that's kind of going down like that, yet it has awesome numbers, then I'd say take a look at the financials and go to those earnings reports, which they're not in Tykr yet. We want to have the MP3 files at some point where you can download and listen. Maybe ChatGPT can take out highlights there. That's a different project, but yeah, so those are the reasons why. It's just unfortunate with Enphase, because I actually like this stock. I see Mustafa was saying Enphase is suffering from China solar trade disputes, interest rates. Yeah, I know a lot of companies can be in that same spot. So, yeah, good call out there. Looking
When it
here.
comes to a lot of the reasons you don't like retail is a lot of the reasons I don't like renewables. Nothing to do with the tech, nothing to do with anything. It has to do with governments getting in the way and screwing everything up, basically. So
Yeah.
there's a reason that
Yeah.
there's a reason everybody's favorite creator, Mr. Beast, can go dig like 500 wells in Africa in a couple of weeks. And there's entire government entities out there who have spent 10 times as money and not done 10% as much. So
Right. I know Jan here was talking about interest rates. Solar saves you 10%. You can borrow money at 2%. There's a nice spread. Yep. Multiple variables. I still, we could go down the renewable energy and electronic vehicle trend for another whole video in itself, but it's, the world is moving that direction. I think it's only like 2-3% of the vehicles on the market right now are electronic. I think, what is the expectation by 2040? It could be 50% of the vehicles.
no, that's
So
totally wrong. No, because the problem is this. The problem is we have a government who sits there, and sorry guys, I'm middle of the road on this stuff, the politics, okay? But I view everything from the perspective of making money and realism. So what happens is they've put out a lot of credits, they put out mandates that will never be met, all these different things to try to fuel the EV market. The major problem and limitation of making that happen is going to be infrastructure. When you look at the infrastructure of fueling stations, they are dramatically behind in California, which has the most money going towards these kind of projects compared to any other state. And all the other states are taking a long time too. The only place that is getting, and you can see this because Ford made a deal with them, right? The only place that is actually putting these things up in a timely and cost-efficient manner is Tesla. That's it. So that's why Ford came in and said, well, we're not going to wait for the government to come around and, get these EV charging stations up. So you know, I still think, yes, EVs will continue to rise in popularity, but there's no possible way we could have 50% of cars on the road that are all EV at that point in time, because there's no way there will be enough fueling stations for them to be able to do it. So that's my
I actually believe
perspective on
it can
that.
get there.
You think it'll get there?
I think so.
More of an optimist than
2030.
I am.
I know 2030, no, but 40, I do believe it. They're going up left and right here where I'm at in Wisconsin, which is, very much lagging indication state compared to others with getting an infrastructure in place. But we are making progress. It's good to see.
You'll see Tesla Cybertrucks up there soon enough. Wisconsinites, they love to haul some things.
Oh, yeah, we love our
I can't wait to
trucks.
see a guy hauling a deer that he just hunted down in Wisconsin in the back of his Cybertruck. It'll happen.
I don't see it. For some reason.
That's a very weird image to think about, isn't it? But my brother-in-law is up in Wisconsin. I promise you.
Okay, sure. Here's one from Jan. Buy a cruise line after crashes when someone throws up. Yeah.
Jan, I like that one.
Yeah. There you go.
I'm gonna put $1,000 to Carnival in your honor the next time I hear that happen.
Right on. Yeah. All right. We've got a few minutes here. Anything else, you guys? Any other questions or maybe another stock we want to touch on? It's really good questions, guys. See if anything.
I'll throw one out there.
Sure.
We have. I think you said you had funds on there. Let's look at TQQQ, one of my favorites.
TQQQ.
It's the triple leverage QQQ. So if you don't have that
An
one,
ETF. Got it. Okay.
So we haven't looked at an ETF yet. Let's see what that looks like.
Yeah. So yeah, if you guys haven't seen this within Tykr, you can see the allocation right away. So we're at about 28% on sale, 48% of this watch, and then 22% overpriced. Look at this for the year to date, 188%. Whoa.
This is one I like to play with. So I'll get in, get out on some runs because it is triple leverage. So
Yep.
A lot of volatility there. Would have been nice if I would have just held it, but I've done pretty well with it this year.
Nice.
So,
Look what's in it though. You've got pretty much the
primarily
Magnificent
all
Seven.
the big techs.
Yeah. Wow. Let's jump to page 2 here just to see. And you guys, if you don't already know, you can see your allocation, your weight. Okay, so Apple's about 1%. All right, we've got Tesla, Adobe as well, Costco, Pepsi, AMD, Netflix. Really, really impressive. Yeah, it makes total sense if you're seeing returns like that. Very interesting. Yeah.
And then if anybody's curious, if you want the much less riskier version of this, it's just QQQ.
All right, jump there. Yeah, very similar weight per summary. And just jumping up here. 52% for the year. Nice. Which the market, I think the NASDAQ is about 50%. The S&P, I think when I was checking today, was over 20 some percent.
Yep.
Yeah. Yeah, same stocks here. Okay, so weight on this one.
It's the same thing. It's just triple leveraged.
Yeah. Gotcha. Okay. Very cool. Yeah, for those of you that you want to go into ETFs again, good for wealth protection. In most cases, you're not going to see the big returns like this. It'll be closer to that S&P 500, but interesting call out here. I see SOXX. I believe that, Aaron, that's a semiconductor. Let's take a look here. Yeah, look at this. 48% on sale, 41% watch. So much smaller little sliver here of overpriced. Returns are 57% for the year. Let's go to the 5-year, just take a look. 233%, that's solid. And then you got your big players in there. You've got AMD, Broadcom, I'm familiar with, Intel, of course, NVIDIA, Texas Instruments, Micron, I see at 4%. All the usual suspects. Yeah. Marvell. I hold AMD. I really like AMD and NVIDIA. Semiconductors, I know I talked about the risk of manufacturing But semis go into everything from like cell phones to vehicles, microwaves, refrigerators, TVs, the list goes on. So I do like those stocks a lot. I probably won't put all your capital into one semiconductor stock, but it is something that I think maybe consider adding to your portfolio. Cool. All right, kind of winding down here. Why don't we let everybody know where they can reach you?
Yeah, I can put this in the chat
Sure.
real quick. Big place to get me is on LinkedIn, but if you want, you can go to my website, coursonsolutions.com, and most of my information's there. The podcast is listed up there. I have a lot of free resources like weekly podcast and articles that I do, and then other resources as well that people can check out if they're interested.
Cool. I just found podcasts. A lot of people love promoting your podcast, so definitely check out your podcast there. Did you put that link in your?
Yeah, I will put the link in
Yeah,
specifically.
yeah,
And this is a link to um, the podcast page, I guess you could say.
sure,
So all the major platforms, you can download it from there, the iHearts and Apples and Google Plays and all that.
sure.
Actually, I think I heard, isn't Google shutting down their podcast platform? Did I hear that right?
Really? Hmm.
It could be wrong about that, but there was a major platform that I thought was uh getting shut down.
Do some searching on that offline. I honestly, the audience here probably listens to podcasts either on, I assume, Apple or Spotify. Seem to be two big players.
Yeah, yeah,
Yep.
that's probably 96%. Yeah, Google announces a 2024 shutdown date for it. So that's
Okay.
interesting. I've never listened to any. I use Google for a lot of things. That is not one of them.
Yep.
So not shocking.
Right on. Heads up to the audience here. We've got one more. I try to do a Ask Me Anything or more like I call it more live stock review. We've got one more December 19th. It's Tuesday. That'll be next week at 8 a.m. A little more friendly for those who are, across the world than 11 a.m. slot, Central Time at least. So yeah, we'll get one more and then I'm going to try to line up a few more of these in the new year, but we'll definitely have you back on. This was a good discussion. We'll come up with another maybe 3 to 5 things that are really important, and then dive into open Q&A thereafter.
Yeah, that'd be great. We were talking about 2024 already, but here we are.
All right. Unbelievable. Cool.
Well, Sean,
Well,
thanks so much for having me. I appreciate it. And thanks everybody and the community. It's been fun talking with everyone.
absolutely. This was really a great time, guys. Thanks for the good questions. And I'm going to work on getting this up to our YouTube channel later on today. All
Have a
right.
great day, everybody.
We'll see ya later.